Let's welcome in our next guest. Ajay Bagga now joins us. Ajay, you've looked at the markets for quite some time, especially the valuation bit. A lot of people are of the view that valuations are now looking attractive, but there are some who say that still the EPS cut is not particularly factored in by the market. If you factor that, valuations are still quite expensive. How would you look at the market after correction?
Yes, we have to keep in mind historically India is at a premium in price earnings ways, and that normally used to be because the growth factor was higher in India. So we would factor in a PEG in India which was more conducive than the other emerging markets. We would get a premium valuation. Right now what's happened is 2017 EPS has been cut by most sell-side brokerages by 20 to 30%. So you're looking at 3 to 5% kind of growth for the year for most of the coverage companies that brokerages come out with. 2018 impact, now let's see what the January figures come out with. Post this quarter's numbers, once they are reported in the Jan 15 to Jan 30th period, for most companies, you will see the 2018 prognostications, and once those forecasts come out, then you will have a better idea. But market is very prescient. Market has a good idea of what's happening on the ground, and also market tends to overreact. So probably we are in an oversold territory. That's why we are seeing that the more informed domestics have been picking up. November we saw 13,000 crores coming into the mutual funds. That was a very asymmetric, very contrarian kind of a bet. Normally what we saw was that the mutual fund money would come in at the peaks of the market and go out at the troughs. So really the retail investor would be losing out. But with the 1 crore plus SIPs now in place, Pankaj, I think that has changed. It's become counter-cyclical. And what's happened in the last 4 days with the FI flows going positive, if that continues, or even if it remains mildly negative, if we get a repeat of November in terms of inflows, then the market does very well. So that domestic support to the market is giving us a lot of confidence.
Right. Whenever such a big exercise like demonetization, GST, any big such changes happen, a lot of industries tend to benefit, a lot of industries tend to lose out. So probably by the end of Jan, or maybe by end of March, Feb, when we'll also have the budget details with us, you're pretty sure that there'll be a lot of opportunities in the market with a lot of businesses changing the way they do their business from the current standards?
Yeah, absolutely. And if you see even technically around the 200 DMA 8180, 8190, the market has held support. We last week when we spoke, I was mentioning that if it crosses 8190 and closes above that for a couple of days, then there is support for the market. So even technically it's a stronger market than 15 days back. Fundamentally, if you look at a lot of the negatives are factored in, and what we are missing is that in the longer term, what demonetization means. It means a lot of companies or business models come under the tax blanket. It means that a lot of the unorganized sector moves into the organized sector with all the compliances. Overall, it aids the revenues of the government. So that might be 1.5 to 2 years down the line. In the short term, there might still be more pain. Nobody can really, the Central Statistical Organization itself is saying they cannot comment right now. But the leading indicators, Pankaj, first is the auto. December we are expecting a big reduction, a big negative in auto numbers. Cement numbers are down. Housing numbers are looking down. Real estate is suffering. Textile sales, retail sales, jewelry, gems jewelry, all these we are seeing immediate impact. So apart from the staples, we are seeing a big impact on the discretionary part of the consumption pack. That is leading us to believe that you will see pretty poor numbers for this quarter. Maybe next quarter also. Government seems quite confident that in 15 days things will be better. I think another 4 lakh crores if it comes into the economy, that will change the picture totally. So it's a V-shaped recovery that we are forecasting, unlike a lot of the street which is talking of a more sustained downturn. I sincerely don't believe in that. And what we are missing out, I think the budget comes in with big bang reforms. This exercise will have given the government a lot more confidence, and the kind of ground level support that the government has found with the municipal victories in Maharashtra and Gujarat, that should have given a lot more comfort to the government on structural reforms. GST, I think market is factoring in now a September 1, April 1 is more or less impossible. Looking at more like September 1, which will be better because more the IT, highway will be ready, the IT backbone will be ready. Plus, companies will get 6 months more to digest the final legislation. So, I think overall things are not as bad. And add to this a global macro, Pankaj, with a global growth rebounding across Europe, across Japan, and very strongly in US, which will really raise it further. And China trundling along, China doing well overall, moving from an export economy to a domestic economy. The macro is much better than this time of last year when we were looking at 2016. That's my belief. So I would look forward to the markets next year.
Right, but as of now, you would not be in a hurry to buy. So buy in a staggered manner, or go via the SIPs or via the mutual fund way. That should be the correct strategy.
Yes, absolutely. I think staggered is better, and especially in the small cap, micro cap. I would say the retail investor is much better served by going through the mutual fund route, because picking those 5-10 companies which are really going to be multi-baggers, leave that to the fund manager to do. They are choosing 40 companies. All they need to do is get 20 of those right, and 5 or 10 of them are multi-baggers. You've seen the performance of the mid-cap mutual funds, the micro-cap mutual funds. Much better. Overall, for investors, what we would suggest, Pankaj, there is going to be 2 rallies. One, you will see probably towards December end. That's a counterintuitive January effect rally, where it's become a Santa Claus rally, where the hedge fund allocations normally come in the last week instead of waiting for January 15th. So you could see some amount of boost there. Second is the pre-budget rally, which will really start off as Parliament reconvenes around January 16th for the budget session. So leading into that, I'm expecting a pre-budget rally as well. Fed is a non-event. Fed is looking like more or less baked in. 92% probability as far as the Fed futures rates go of a rate hike. They can't say much on the Trump policies because they've not seen anything in actuality. It's only pronouncements till now. So you will have a Fed which will just do a holding statement and say, folks, will get back to you in March with the next prognosis. Right now we are looking at stronger growth, and we are okay with inflation going a little more. In case they say we are worried about growth, that hawkish market sells off. So watch for that statement in the Fed press briefing, which Janet Yellen will do.
Right. What do you make of sectors like probably metals, probably IT, which people did not want to buy, or probably the point that you made about consumption, what happens to discretionary spends? These are sectors where it would not have a very big impact on them. So would they essentially now be a tactical buy?
Yeah, I think especially say look at auto. If it falls off another 5%, it will be a tactical buy. NBFCs have corrected quite sharply, 10 to 25% off on the NBFC space. I think those can be looked at again, not cheap, Mark you, 3 to 4 times price to book still, so not cheap by global standards. But if you have a 30% growth embedded for the next 3 years in some of these, I think you can take a bet. Overall, what will do well globally, if you look at financials doing very well, energy doing extremely well, so and metals. So cyclicals are back because of the pro-growth stance of the global economy. We have to follow that. Where we lose out on, last week, for example, Nasdaq was up 4.2%. And RIT is struggling more because of the protectionism. So we have to study that more. IT in a counter-cyclical way, in a contrarian way, I'm still bullish on, because these are well-run companies with good business models. It will hurt the US economy more if they take over, and they are not enough. You look at the labor participation rate today, Pankaj, at 4.6% unemployment in US. They don't have those people who can replace these hundreds of thousands of H-1B workers. So I think once Trump is in office, he'll have to take a more measured tone. There are not enough engineers in the US to do the work our IT majors are doing. So if it falls, like today it's down 2%, another 2 to 5% down, these become a strong buy, if not even now.
Right. Ajay, can you explain to us a little more on why you're expecting a V-shaped recovery? You said you're expecting a V-shaped recovery in the markets, but on the ground, are things going to get better in a V-shape as well? Now, over the weekend, I went to a beauty parlor, and I first question I asked was, I hope you have a card machine. He said, no ma'am, sorry, only cash. I said, but nobody has cash. He said, madam, you pay me next time. You know, businesses are suffering. You're saying a lot will get into the organized sector, but it's not going to be so easy. He said, I've applied for a card machine. My number in the waiting list is 1,86,000. I'm waiting. Now, this man is going to lose his customers. People, in services, other than just the convenience or the cost, there is another pull factor. So businesses are losing, and, there is no compensation for what they've lost. And perhaps this loss will never be made up. So on the ground, are you expecting a V-shaped recovery?
Yeah, I think these are very good points. And, if you look at the services PMI, which came at 46 read, that really reflects what you are saying. But, I was in Bombay, across the weekend, going around markets, looking at sales. Retail is down, jewelry is down, whoever cannot get the card is impacted, but the small eateries, they were full. The cinema halls didn't seem to lack people coming in. So wherever they were already accepting the digital payments, they are not suffering. The taxis are suffering, autos are suffering. There is a lack of cash. And if this is true of Bombay, just imagine what's happening around the country. So yes, there is a slowdown. And as I said, this quarter, you're going to see pretty horrible numbers. Maybe it lasts for another 1.5, 2 months till another 4 lakh crores gets put into the economy. But then, that starts getting better. What we are seeing, a lot of the SME companies reporting that they are finding parallel ways. People are giving Big Bazaar coupons to their labor to go and buy groceries straight. People are finding other ways to survive. There will be business models which will get wiped out, where they could only do cash, and they do not wish to report to the taxman their turnovers. Those will have to go out of business, but most others are now shifting. I'll give you an example. In buildings in Bombay, people are paying even the vendors who are pressing their clothes, the unorganized laundry, the unorganized milkmen, the newspaper people are all accepting IMPS or UPI or even taking checks. So there is a huge move. Now this is a metro. It's not correct to say this is happening in the smaller cities. Why do I say V-shape? Because most of our economy is services. Once you are not consumed the service, if I've not shopped last weekend, it's gone. If marriages have got cancelled, that consumption is gone. But when the currency comes back, so the 50,000, 100,000 marriages that got cancelled countrywide, those will come up by March. Once this situation eases, and then you will see the V-shaped recovery coming in. Same way on auto. Luckily, this is a cyclical time when you don't want to buy a car or a mobike with a 2016 registration. You will prefer a 2017 registration. So anyways, December they used to take shutdowns of 5 to 7 days. Now it will be a 15-day shutdown that most auto majors will take, so that there's not too much inventory left with the dealers. But come February, if there is a recovery, so now it is very critical, they pump in 4 lakh crores more. That leads you to a takeoff stage. Then there will be enough currency circulating, and it goes back to a V-shape. India is not like Japan. Japan, there were other issues which led to an L-shape. So it came down and it went down. 96 was when the auto sales in Japan peaked, because it was a aging population. There were other things that happened to Japan. That market never came back to those 40,000 levels on the Nikkei. But we are a young nation, and we are not keeping in mind 2 bullets that the government has. One, there will be huge reforms coming in. They have to give positives to the population. I think you see tax cuts for the tax-paying public coming in. December 30th will be very critical. Let's see what other measures come in. Third will be, there will be a huge rural thrust now, and that will come off on a good monsoon and a good pay commission stimulus already lying in the economy. Unfortunately, people were not able to use that stimulus because of demonetization. As the currency comes back in the economy, all that will take off again, and then you will have PMI reads on services of 54, 56 also, like we've had 46 today.
Right. Mr. Bagga, so what you're saying is that growth is impacted because the currency is not there, and once the currency comes back, everything is back to normal. Then what happens to the cost of capital? Because the RBI action is done and dusted with. They did nothing. They just decided to stay put. Now, does it mean that once the growth is back, there really isn't a case for lower rates, because there is a big inflation risk coming in from crude, which has rallied, and from January onwards maybe it's headed up even higher. So do you think the prospect for banks is now a lot different? They in any case going to suffer from no business being done in the month of November and December, and with interest with their margins coming under pressure, would banks be then out of favor for you?
No, banks, what you are saying is totally correct. I think what moved RBI, for example, was the kind of outflows they had seen in October, November, and in the first week of December. November, for example, 17,000 crores of debt outflow, and December, in the first 6-7 days, we have seen 17,000 crores. So RBI has seen that if they had cut rates more, the FIs would have booked more profits, and there would have been more pressure on the rupee. You look at the last fortnight's foreign exchange read, it's down $1.4 billion. Our information from the street was public sector banks were told to defend the dollar to defend the rupee at any cost. A lot of the FCNR flows were also going out across November. That is done and dusted. So FCNR is now out of the way. We have done a great job in maintaining the currency while repaying the FCNR. Now coming on banks, the issue is NPAs remain. 70,000 crores of credit has contracted because there's been huge repayments also coming in. We'll have to wait and watch. January, once the results come out, we'll get an idea. Our thesis is that a lot more money will stay back in the banking system. At least about 4 lakh crores odd will be sticky, which will stay put in the banking system. So liquidity changes. Second is that there would be some NPA repayments in cash which would have happened. Third is overall the structure of the economy is going lower cost as far as the yield curves go. We have seen a temporary reaction to RBI, and RBI was worried more on the global factors and maintaining a US versus India yield curve differential. But look at the yield versus the base rates of the banks. They have not really transmitted down the RBI cuts, and there's a lot of gap there. As companies come in and start issuing CPs in the market at lower rates, the banks will be forced to bring down the base rates further. And I think that will happen over the next quarter, and you will see lower rates coming in even without an RBI rate cut. RBI's hands might be tied because they would like to maintain the differential with the US yield curve. With the US yield curve moving so fast up, nearly at 2.47% for 10 years, they can't really cut very substantially. Maybe at 25 basis points, which is neither here nor there, given the kind of transmission lag that the banks have been exhibiting. So I think the more focus will be on banks to transmit. Banks will benefit from the India growth story. Growth comes back in 2018 quite strongly in the cyclical sectors. Overall, the situation will improve. Some industries will see move from unorganized sector into organized. Some reforms will come in. I think all that will help in the banking system. So on a cyclical sector basis, I would still be positive on the banks, more on the private sector banks and on the consumer focused NBFCs.
All right. Thank you, Mr. Bagga, for speaking with us at NDTV Profit and sharing with us your views on the markets and the sectors that you like.